Welcome to the last installment of our 2017 webinar series. This year's theme was Creative Solutions, Our Concepts, Your Clients. Each month, we focused on stories of your clients spanning through various generations. We've explored plans for your professionals starting on their careers, newlyweds and growing families, small business owners, and soon-to-be retirees. We've shown you how we carefully crafted risk management strategies to help your clients enjoy life in the moment. This month, we'll focus on the importance of policy review as a new year begins. Each month's series lasts about 50 minutes, and you must be logged on the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come. Today's webinar is being recorded and will be posted to our website within a week in case you missed it. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring the insurance and financial services industries to ensure your clients are getting the most up-to-date recommendation. He joined LLIS in 2003 with his CFP and MBA and has been writing the LLIS story as president and CEO since 2013. And now, Mark Maurer.
Thank you, Taylor, and welcome everybody. Thank you for tuning in today to the end of the 2017 series of webinars, and just thank you for all of your support this year. If I could, come down everybody's chimney and give you a nice present, that would be great, but I don't fit anymore. So thank you all, and so it's the end of the year. What are things we do at the end of the year? We get stuff out of the attic, we start doing a little spring cleaning, and it's a great time to start looking at policy reviews because it's insurance. But this is our Florida winter here. I think it got into the 50s, and you can hear the heat going all up and down the neighborhood. But we have Florida winter, and that's pretty much it, a sand snowman. So it's the end of the year, and we start looking at different things, setting up for next year, and also re-looking at the past year. So I'm going to talk about some term insurance reviews, things we can do that to set ourselves up for next year, disability insurance reviews, universal life reviews, even long-term care reviews. But let's talk about term first. Term, because it's set up sometimes as a 30-year guarantee, fixed amounts of coverage. We usually get it when you're younger, maybe healthier, haven't added some pounds on us as we get older. So a lot of times with term policies, especially if they've been in force a little while, really the question is not so much, is this a good premium, or is it still working for them? It's still working because we know sort of what the design was, but does it still fit? Somebody who got $1 million term policy when they had their first job and now they're making a lot more. That one policy may not still fit as the total amount of coverage that may be needed for income replacement. How about the term length? We'll have advisors who come to us with clients who have things set up early on in our 20s and 30s, and sometimes people end up having babies in their late 40s that nobody really expected, and so the term coverage that ends in 5 or 7 or 8 years may not be a good fit anymore. It may need to extend another 15 or 20 years now. And again, if somebody was issued at a preferred or preferred plus rate, there's going to be different premiums based on the different companies. But if there's a policy that's 4 or 5 years old and somebody was preferred or super preferred, more than likely we'll take a look at it. But if they need something else or different, we'll probably look at supplementing rather than doing something and replacing it. But sometimes it does make sense to look at, is this coverage still a good deal, and does it make sense to replace it? Carol's 54 and she's in great health, and her advisor came to us and said She has the ability, my client Carol can get $500,000 of group life through work for $105 a month. She was born in 1963, so she's 54, female, and great health. So we said, okay, well, $105 a month, that might be okay. That doesn't sound like a whole lot for $500,000 of life insurance. But you've got to get under the hood, take a look at what's there, sort of unwrap the presents, if you will, get under the tree, if you will. It's the holidays. I have some good analogies here. So Carol, $105 a month at her current age for that $500,000 of group term. What's important to know about group term, and not necessarily the coverage that the employer pays for, but the supplemental coverage, what the employee is adding on top of anything that the employer pays for, is that group term premium rates are based on quinquennial ages, which is a really fun word to say, but what it means is that it means every 5 years. So Carol being 54 is in one age rate between 50 and 54. When she turns 55, those premiums are going to increase, and she'll pay the same premium from age 55 to 59. That's good if you're 59, not so great when you turn 55. And then the premium goes up again at the next 5 years at her age 60. So if she keeps this policy for the next 10, 12, 15 years, she'll have three of these increases, and the increases aren't small. As you can imagine, if I lump a 50 and a 54-year-old into one rate, I've got to have a pretty good increase to go from the 55s to 59-year-olds. So those rates are going to increase. So we look at what does it cost now, but what are those increases going to be? She's in good health, and so we talked about a moment or two ago, if you're in good health, there's a lot of things you can do. A $500,000 locked in 10-year level term, $64 a month at the second best preferred rate, or less than $50 a month at super preferred, that preferred plus rate. So if she's in good health, even if she can't get the preferred, standard plus, standard, still going to be less than $105 a month for the group coverage, and it's going to be locked in for 10 years and no increases. But not planning on retiring at age 64, maybe work a little bit longer. 15-year term, good health, $63 a month at preferred plus, $78 at preferred. Even again, not exactly the preferred, still better than the group term. So it can have a lower premium now and a lower premium in the future as those increases happen. So next year, her premium is not going to be $105 a month, but with the term, the 10 or 15-year term, it's locked in. So why does this work? Well, group term normally asks very few, if any, health questions. The basic assumption is that if you're working for the employer, you're alive, which sort of makes sense, but you're healthy enough. So they're going to have sort of one rate class, and that's why we sort of have that. There's either male or female rates. Sometimes it's not even male or female. Usually there's a male or female and a smoker, non-smoker rate. So usually there's 4 rates, and then depending on your age, for those 5 years, you're in one of those 4 rate categories. So because they're not asking a lot of health questions, they've got to sort of combine people who are in great health and people who may be not in so great health. So if I can say we're only going to insure the healthy people, I can have a low rate. If I say everybody who's working there, and I'm guessing somebody there is, 2 breaths away from a heart attack, then I've got to have this rate that's covering everybody. So with no underwriting, I have a one rate that's got to cover healthy and unhealthy people. So it's a great deal for unhealthy people. If you're in better than average health, like Carol, you can see the premiums for stepping out, looking at it herself, can save quite a bit of premium. Disability insurance, disability reviews. And this is probably the majority of my day on any given day, is working with fee-only advisors, helping review existing policies on sort of any of these topics: life insurance, disability, long-term care, annuities. So that's a lot of what we do. If you are new to us or working with us, let us help you review existing policies. Some of you have done insurance in the past, and so you may sort of enjoy looking that up. If you aren't that familiar with it and a client comes with 4 whole life policies and 3 annuities, and they say, what do you think? We're happy to work with you, figure out what the client's needs are today. Do those existing policies work in with what they have? Is it better to do something else? And maybe what they have is just fine. Like I said, with the term policies, if somebody had good term policies set up, the amounts still match the need, the length still meets the need, they can be perfect. So we'll talk about disability insurance. Group coverage. If you have group coverage, either employee or employer paid, to me, that's just sort of like a check. It's good. Is it possibly going to have all the bells and whistles that an individual policy has? No. But it's either employer paid, which means the client doesn't pay anything for it, or group disability rates are usually very low, so it's a good deal. So to me, if somebody has group coverage, that's just they have group coverage, great, check. Do they have any existing other coverage? So this is individual disability that they own themselves, usually considered supplemental. Usually supplemental if it's added after the group. But do I have these 2 policies? Group and then any individual. So how much of that do I have? What's my income? How does this all fit? Like I said, how is my income? Well, maybe when I took out these policies, a good example are medical residents. They start with a get out of medical school, and sometimes through their programs they can get a $5,000 a month disability benefit, sort of that streamlined underwriting. They start working at a hospital, an employer, and now they've got some group coverage. But hopefully they're making a good amount of money. And so they have that $5,000 a month that they already had. They've got some group, but they're making $100,000 more than any of those other assumptions. So do we need additional coverage on top of that one? Maybe they can get a better occupation class. So when we review existing policies, that's something we're looking at. Financial advisors are a great example of this. When you start off, usually within the first 2 years of being a financial advisor, and you're usually making $50,000, $75,000 or less, most insurance companies will consider you for one occupation class. But after you've been established and you've been in the field for 2, 3, 4 years, and you start making between $75,000 and $100,000, then you can get a better occupation class, which means that the policy is exactly the same, but the rates you're paying are lower. Sort of like the difference between preferred and preferred plus is your health on a life insurance policy. The occupation class is sort of the health of your occupation. So somebody with a higher income, more stability, longer time in the industry is going to have a lower risk of claim than somebody brand new. Financial advisor who's been in the industry for more than 10 years and makes more than $150,000. It's probably even another occupation class for lower premiums, given everything else being the same. So those are the sorts of things we're looking at. Maybe the occupation has changed, maybe their income has changed. Valerie is 31 and she's a hospitalist, which is a hard word to say. And she has $3,198 of individual disability, and she's paying $1,645 annually. So this was a $3,000 policy that she'd gotten through her residency program, and it has some little sort of annual increases. So she had that when she got out of her residency program. Now she's working at the hospital, so she has some group disability through her employer. And so the advisor came to us with the client. Will you all please take a look at her disability coverage? She has this coverage. How is she set up? Well, we sort of said the group, that's a check. Now let's look at the individual disability coverage. It has a 90-day elimination period. medical definition of disability, which is one particular insurance company's definition that they use and recommend for physicians. 24-month limitation for a mental nervous claim or mental nervous disorder. We'll see these a lot with in this case, like the $3,000 a month. It's has that streamlined underwriting. She probably couldn't have gotten $10,000 or $15,000 a month. It's probably limited to $2,500, or probably $3,000 in this case, where the insurance companies say, you're graduating from this residency program. You know what? You're going to work. You're going to make an income. So we'll let everybody have a certain amount of coverage without having to go through verifying your tax returns and things. So we'll offer everybody $3,000 as a simplified underwriting. Part of that, though, is that there's going to be a 24-month limit for mental nervous issues. Those are usually the number one claim at any disability insurance carrier. So it's going to have a limit because they can't ask some of those questions. And that's it. That's the annual premium, $1,645. So we asked the questions of ourselves. We said, selves, do we need a third layer? Is there an option here? And yes, based on her income, she was eligible for another $6,500 of monthly benefits. So we're sort of adding that third layer. The group DI is the base. We looked at this individual DI as a second layer, and then this additional $6,500 of individual disability right on top of that. And so this new plan would have a own occupation definition, 90-day elimination period, $2,975 annually. So if you're doing the math, that's a little bit better deal. Part of it is because she is in a higher occupation class than with one company than what she was issued at for the her sort of simplified policy. So we asked ourselves a question. We said, selves, I'll stop that, I promise. Does it make sense to have 3 layers or 2 layers? So if we have 2 layers, we have the group DI plus the existing coverage plus $6,500 of new coverage. So the annual premium would be, sorry, that's not added up right, or it's not added up right, but $3,975 for the $9,600 of disability benefits. Or we could do the second layer. What if we just do 2 layers? And instead of using that one policy that was different, we could add more coverage. So instead of replacing that existing policy because their new coverage was going to get a better occupation class, and revisit down the road, but consider replacing that existing policy because their occupation class had moved up like 2 steps. And so to add all new coverage was better than keeping additional coverages. So sometimes the decision is as easy as deciding whether to answer, have you been naughty or nice this year? And so next thing is reviewing existing life insurance policies, not term policies, but permanent policies. This is probably where I do the majority of these here at LLIS. And so when clients have existing cash value policies, I take a look at a lot of those. So we have questions about what to do with old policies. In this case, it's going to be a universal life policy, but it would, a lot of what I'm going to talk about would translate to a whole life policy. Anything that happens to be a cash value permanent policy, we look at different options. Dr. N came to us through his family financial advisor. He has a $2.57 million universal life policy. And a few years ago, he paid $1 million single premium. At that time, he was rated a Table 2, so not a substandard. You have your super preferred, your preferred, standard, plus, standard, and then table rating. So a notch below standard because of some previous cancer history. The advisor came to us and said, Mark, can you take a look at this policy? Still the $2.57 million policy. Today it has a cash surrender value of $959,000. So we'd put in $1,959,000. Pretty close. The concern though was under current charges, current interest rate assumptions, this policy was going to only carry to his age 93 and then lapse with no cash value or death benefit. Now, I don't know that I'm making any plans for my 93rd or 95th birthday party, definitely not today, but that's a concern to most people, especially when they thought that they paid $1 million and believed that this was going to be there as long as they're around. Well, if it was when they purchased the policy and now it's at age 93, if interest rates stay low, decrease, we can have this issue where every year that end date starts getting closer and closer. So he's a doctor, had a little cancer issues, but is worried that age 93 may not be long enough. So what options did we look at? Well, he needs the life insurance, wants the life insurance. So really, besides keeping the existing policy and either reducing the death benefit, which would keep it going longer, or adding new premium, which he sure didn't want to do. If I wrote $1 million check for anything, I don't think I'd want to pay anymore. So we looked at the question of what's another option? Oh, question. Why does he lose the cash value at 93? Is that part of the policy contract? Good question. Today, there's $959,000 in the policy, and consider that like the gasoline in the car. Every year that goes by, there's cost of insurance that come out and interest that's earned on those cash values. What's happening is that the costs for his insurance for that much coverage are more than the interest he's earning every year. So the $959 is being eaten away to pay for those costs of insurance. And what happens is at age 92, there's $20,000 left. By age 93, the cost for one more years of insurance is more than the $20,000, so it's eaten up. So it's not really part of the policy contract. It's just that the costs of insurance are more than the interest he's earning. So it's eating away at principal, and then it lapses because there's no cash value left. And he didn't like that. The advisor didn't like that. So what's another option? We said, well, let's look at a 1035 exchange. 1035 is a section of the Internal Revenue Code that allows you to change ownership and transfer cash values from one insurance company to another, like an IRA rollover. Why do we do it? Because there's no tax involved. So let's do a 1035 exchange from the old policy to a new policy to a no-lapse guarantee universal life policy. A lot of words there, but this one is a premium-based policy rather than a cash value-based policy. His current policy says if there's some cash value, the policy is in force. When it goes away, it's gone. A no-lapse guarantee policy is based on premiums. It says if X premiums are paid, we guarantee Y death benefit for a certain amount of time. In this case, we said we want that X to be his cash values to solve for that Y death benefit that guarantees the coverage for his lifetime, even if that's 120, 121. Now, long term, there's no cash values with this policy. They're generally sort of like a single premium term policy is a way I think of it a lot of times. But compared to what he has now, the cash values are going to get used up anyway, and then it lapses. So let's use the cash values he has now to use it so it doesn't lapse. We get a benefit that he's a standard non-smoker rate today. A lot of times with cancer, the farther out you are from the diagnosis, the treatment, no recurrence, you can get to those standard rates. So he's a standard non-smoker today. So that helps. And that cash value that he has will guarantee $3.6 million of life insurance, even though he's older than when he took the existing policy out. But we get the benefit of this particular policy being death benefit oriented and designed for death benefit, and that standard non-smoker rate helps too. And that guarantees $3.6 million for his lifetime with no future premiums. 40% increase in life insurance, and the legacy planning, which was his goal of the policy, is all done. It's checked off. We took those cash values, guaranteed a policy that he can outlive, and so all of his other assets, whatever else he might have, are available to be spending, used, what have you. That legacy planning part, somebody will get $3.6 million of life insurance. And I have a question. If the cash value is less than the premiums paid, why would there be any taxes due? In this case, there's not. He put in $1 million, so that's a good question. We'll touch on that a little bit later. If the cash value is less than the sum of premiums paid, there's not a taxable event. So the follow-up question is, why not just cash in the policy and start over? The reason not to would be because there would always be a gap in coverage. If Dr. N wanted to write a check for $900,000 to put a policy in place and then cash the other one in, then you wouldn't have a gap, but most people wouldn't be able to write the $900,000 check. So somebody would have to surrender a policy, wait to get the cash, check it, to write a new policy, to put a print policy in place. And so you have that, you'd have a gap where somebody wouldn't be covered. So good questions. Moving on to Maria. And back in 1990, everything was going really well. Holiday party, and she was working, and she got some insurance. By the way, look there on the right, the second person from the right. Does he not look exactly like the elf on the shelf? Maybe that's just me, but I saw this, I started giggling because he looks so much like the elf on the shelf. Anyway, I digress. In 1990, Maria got a $100,000 group UL policy, and she was paying $32 a month. In 1993, she then took out a $100,000 whole life policy, paying $1,023 a year. Let's fast forward to today, 2017. Maria is now age 59, and her fee-only advisor came to me and said, Mark, here's my client, here's her existing policies. Can you take a look at them and maybe give us some ideas what to do with them? I said, sure, happy to. So she's 59, asked about the group UL policy. She's still paying the $32 a month. She's built up a little over $10,000 of cash value and has a $10,300 cost basis. Cost basis being the sum of after-tax premiums paid in. And we requested some information, and it said that if she just keeps paying the $32 a month, no changes in premium, makes no changes, it's going to lapse sometime in her late 70s. Now, where I talked about not necessarily planning for my 93rd or 95th birthday, I kind of do expect that I'm going to make it into my 80s. I've got pretty good longevity and, in my family. So, if I don't plan on lapsing in my late 70s, so we don't want the policy to lapse in the late 70s. So, the issue here is that if she just keeps doing what she's doing, it may not last as long as she does. So, do we increase the premiums to keep it going? What are some ideas for her? And then we take a look at the whole life policy. Because it's whole life, she's still paying the $1,023 a year. This one, she's built up a little over $50,000 of cash value. This one's performed better, $27,000 of cost basis. And so we asked the advisor, okay, she has these two policies, a little over $200,000 of life insurance, paying $1,300, $1,400 a year. Tell us about her and her husband's situation. And this is what I love about working with fee-only advisors is I can say what the policies are and what they're doing, but we on the surface, and almost any insurance person, until you get into the real financial planning aspect of it, is let's find out about their needs. What can we do for them? What are their needs today? Well, Maria's goals today are much more about retirement, cash flow. That's much more pressing than any life insurance. So the ability to free up premiums, maybe get access to some of those cash values, all of that is weighing much more in their minds than leaving a legacy. And they have the policies, they like the idea, but maybe not at the expense of keeping the paying premiums and having the cash values. I had one question. One question I'll come to in just a second. Could you do a partial 1035 exchange? You can't do a partial 1035 exchange into life insurance policies. Life insurance is called an absolute assignment, so all of it goes over. But I'll touch on that here in just a second. I have another one. Is there a general rule of thumb regarding keeping GUL or Group UL after you leave an employer? It's another good question. Sometimes the Group UL is set up like the supplemental term. You just pay for it. It's just a different way of designing it. A lot of times, it's added as an executive bonus or an executive benefit. So probably more often the policies I review for you and your clients are that somebody's retiring and they have this $3 million policy. They haven't been paying anything. So the agreement is that the employer says, we'll pay the cost of insurance every year, like annual renewing term. We're going to keep this going, so it's basically just death benefit. If you want to put some extra money into it, you can, and that grows on a tax-deferred basis and accumulates. But we're going to keep paying all these costs of insurance for you while you're working. So far, I haven't had one where they say, and we'll keep paying it after you retire. So what happens then is the employee gets a bill for $14,000. The employer has been paying those costs of insurance every year, but now all of a sudden the employee has the option to keep paying $14,000, which is going to increase every year. Other options, but you can almost always take it with you. It's just, is it affordable? So that's a good question. All right, back to Maria. What did she, I outlined some different options. What did she and her advisor actually decide to do? Well, for the Group UL, she decided to surrender it. The cost basis exceeds the cash value, so she can cash it in, and there's no taxable event. Sort of easy idea, easy way of going about it. And it frees up the $384 of premium outflow. So not only does she get $10,000 now, anytime we can stop money going out is the same thing as keeping more of your income coming in. So that's a pretty good day. And then for that whole life policy, we recommended doing 1035 exchange of a no lapse guarantee, $274,000. Just this one cash value gives her $274,000. So even more than the sum of the other two policies, so more life insurance. No taxable event. That's why this is really neat. That 1035 now makes sense. If I surrendered it, she's going to owe tax on a couple $10,000, $20,000. With the 1035, no tax, so all of that money gets to work for her. And we also stop another $1,000 of money out. So anytime we can stop money going out, it's good. We get to keep more of it in our pocket. And so to the one question about maybe can you take some money out, here's what we recommended for her next year. And this is an option. Next year, she can keep the $274,000 guaranteed for life, no future premiums. So that's what it is today. Can just set it up, do that, and we know it's there. Or, and I think this is probably what they're going to do, after the policy's been in place for 1 year, she can take a withdrawal up to the cost basis. And before anybody asks about why 1 year, it's just a quirk of this particular insurance company's, is that policy has to be in place for 1 year, and then you can take the withdrawals. So take a withdrawal after 1 year up to the cost basis. So she can take out that $27,144 income tax free. So to the one question about doing the partial 1035 exchange, sort of what we're doing here. Withdraw exactly the full amount of the cost basis, tax-free, after 1 year. The death benefit gets reduced, so it's a pretty proportional reduction. We take out X amount of the X percentage of the cash values after 1 year. The death benefit gets reduced, but still leaves $134,000. The whole life policy by itself was just 100 and some. So it's 134,000, almost 135. So after 1 year, she could take out her cost basis. She gets $27,000 income tax free, leaves $134,000 death benefit. So all of those gains stay in the policy to pass on as income tax free life insurance, still with no future premiums. So the way the design of that, this particular policy is, it's guaranteed. You just reduce the death benefit so it's proportional to keep those lifetime guarantees. So it's a pretty neat design and idea for to the question there about how do I get some of the money out. Rachel G, she's 46. She purchased a policy from Ameriprise 20 years ago. It was a RiverSource VUL, $250,000 death benefit, cash value of $44,000, and she's paying $200 a month. And so her advisor came to us and said, well, she started paying on this policy in her 20s during her first marriage. At a time she thought that she might start a family. They didn't. She's married a second time now, but her new partner really isn't dependent on her income, but she's just been paying into this every year because it was there. So one thing about life insurance is it can be sort of it's a form of forced savings because you pay for it every year. It's coming out of your checking account and you really don't notice it. Married again. So the advisor asked me a question, what could she do with that tax value? What are some options? And is there going to be any tax liability? So I asked a question, and for any of you who ask us to do policy reviews, one of my questions may be, what is the cost basis? If the cost basis is little, like the pot on this tree, then you have the whole tree worth of taxes if you cash it in. If the cost basis goes up above that star, well, then you can cash it in and not pay any taxes. Well, Rachel's cost basis is $33,000. So there's about $11,000 gain. So if she just surrendered the policy today, $11,000 gain, taxed as ordinary income. So the question was, is there anything she could do to avoid tax liability completely? Maybe in freeing up that $200 a month is actually going to be a great option too. And so the advisor said, if we just have to surrender it, that's an option, but I really don't want to create any unnecessary tax bill for her. So again, we use that 1035 exchange to keep this going. Now, we've partnered with TIAA-CREF here just at the end of the year to be able to offer their low-load universal life policy too. And so what we did is we looked at the TIAA-CREF policy and we used a minimum face amount to minimize the insurance charges, to maximize the accumulation component. So what do we want to do? We want this cash value to be for an accumulation. So how do we do that? We minimize the insurance costs. There's no taxable gain at the transfer. That's the 1035 exchange. And it retains the tax-favored benefits of life insurance, which are tax-deferred gains, the ability to take tax-free withdrawals, the ability to take tax-free loans, and have a death benefit that passes tax-free to the beneficiaries. So there was a lot there. I know for a lot of advisors, if you have a UL policy and you want accumulation, or whole life and want accumulation, you look at an annuity. Why not an annuity? Well, with an annuity in UL, you have tax-deferred growth. When you take money out, though, with an annuity, your gains come out first, and those are all taxed as ordinary income. With a universal life policy or life insurance, you can actually take your basis out first, so you can get the tax-free money out first, rather than having to take the taxable portion out. What if Rachel wants to take the money out before she turns 60? Well, with the annuity, we know there's a gain. If she takes it out from the annuity, she's going to pay a 10% IRS penalty on any of those gains. So if she takes out $11,000, there's a $1,100 IRS penalty. With the life insurance, none. Can't take loans against an annuity. You can with the UL. Is it a tax-free death benefit? Even though it's called death benefit annuity, it's not tax-free. If it passes on at death and there's any gains, beneficiaries owe money on the gains. Life insurance, tax-free. And can you have some downloads? Yes, for the annuity and the TIAA-CREF UL policy. So for Rachel, we found $167,000 is about the smallest policy that a 1035 exchange of $44,000 will work for her. After 1 year, she has a cash surrender value of $45,000. So that's pretty fantastic. There's no surrender charges, so she has immediate earnings in this policy. And after age 65, it's predicted she'll have an $81,000 cash value, and that's at the current 3.85% current interest rate. So what's a neat bonus about this particular TIAA-CREF policy? Well, I've seen a lot of things come out and they call it RIA friendly. Well, it's an RIA friendly policy that allows you to download the cash values into your planning software to add them to AUM, not but AUM. Sorry for the spelling. AUM. Because this is money here that you're going to help manage in their overall portfolio for accumulation and monitor it as part of their, in this case, fixed income buckets. Tax planning. We don't want her to pay the $11,000 ordinary income tax, so this is tax planning to help defer that or even avoid it completely. At age 65, we can look at retirement income. There's a gain, but maybe she can take withdrawals, loans, maybe annuitize it, lots of different options for her. And we're also providing for legacy goals. So a lot of advisors are looking at the importance of insurance in a comprehensive plan. And so this policy can be added to AUM downloads and software, because you're not just setting it once. You may be helping to monitor it for many, many years and use it for income, or figure out where's the best place to take from income when they get to retirement age. How about quarterly premiums? Let's do a little quick administrative review. Quarterly premiums, if we can avoid them, please do. Now, everybody tells me that top line is the quarterly. I'm colorblind, so I'll go along with that. But quarterlies have the highest incidence of lapse. And I think it's because it comes every quarter. And most things in life aren't quarterly. They're annual or they're monthly. So you get your premium notice, you pay it a little late, you get your reminder, you say, I just paid that. You get it again, you say, I just paid it. Well, that was the next one. Don't recommend quarterly, especially don't recommend it when you compare to monthly. Look at the cost. We think it costs more to go from semi-annual to quarterly and quarterly to monthly. No, it's actually a better deal to go monthly instead of quarterly. So monthly bank draft. If needs be, quarterly bank draft, so things aren't missed. But like I said, the monthly bank draft, it may be more frequent, but it normally costs less, and there's a less chance of missed payments. Long-term care policy reviews. Now, I'll just say long-term care policy reviews are usually my favorite because it shows the importance of getting coverage when somebody's younger, when they're healthy, and you as advisors can use this to say, look at how, you listen to my recommendations, great job. Allison and David in 2008 got a $200 a day policy, 3 years each with shared care, 90-day elimination period, 5% compound inflation rider. Allison's just a little bit younger. Her premium was $151 a month, and David is $154 a month. Sounds pretty good. 2012, unfortunately, they got a notice of rate increase. They could reduce the monthly benefits. They could have reduced the years of benefits. They could have probably something else there, or reduce the inflation option, which is what they chose to do. So they reduced their inflation coverage from the 5% compound to a 4.2% compound, which is still a solid amount of inflation coverage today. And in 2012, their daily benefit had already grown to $244 a month. So in 2012 going forward, that's $244 a day of benefits growing at 4.2%, keeping the same inflation option. It's a really neat feature about long-term care. If rate increases have to happen, which we hope they don't, but if they do, a lot of times you're given good options to keep your premiums about the same amount as where they are today. And the advisor called us this year, said, Mark, is there anything we should be looking at these policies? Can you get some information for them? Well, their policy has grown to just about $300 a day. Still has the 4.2% compound inflation rider, still paying $151 and $154 a month each. So my question is, how does that compare to something else today? Well, they're 9 years older. So costs for everything go up as we age. It's $300 daily benefit instead of our original $200. So we had $200 a day at younger, and we have to compare to $300 a day at 9 years older. Keeping the 3 years each with shared care, keeping a 4% compound inflation. Why do I like long-term care policy reviews so much? Because today, Allison's premium for something similar would be $710 a month. Now, part of that is because she's older, larger benefit, changes in premiums, but insurance companies have gone to gender-specific premiums, where in 2008 they were males and females all paid the same rate. So she has a 370% increase. David, his is really just being older and a larger benefit, 180% increase, so $430 a month. So what's our recommendation? I think this is a Zales commercial or some insurance, not insurance company, jewelry commercials. It's a keeper. Those policies you can't do anything like that today. And so that, reviewing those hopefully helps everybody feel good, even with those rate increases that unfortunately we get. 10, 15% rate increases. New policies may be double. So even with those rate increases, it's still almost always best idea is to hold on to the existing policy. Now, the good news is that policies today have a lower projected rate increase likelihood. Policies priced today are higher to start than they were in the past, but they're using low lapse assumptions. They're using low interest rates. They have much better claims experience than they did in the past. So the good news is that policies today are less likely to have rate increases. The bad news is that the premiums are higher for similar plans in the past. So for clients who are looking at policies today, it's good. They're unlikely to have much less likely to have rate increases than people with policies from a while ago. The flip side is that if clients have policies from a long time ago, they may have those rate increases. But so far, I haven't seen any time where accepting a rate increase usually comes even close to what a new policy would cost today. And the last thing we're going to touch on is, what if clients have life insurance but need long-term care? There's some really neat things we can do in the hybrid life or asset-based care or hybrid life, hybrid annuity world. So life insurance or annuities with long-term care riders. Catherine and Joseph, their net worth is about $6 million. They have no debt, $750,000 home. And in their minds, in the advisor's minds, they said, we have this unneeded insurance. It's life insurance. We really don't have much of a legacy goal. Our fine, at least leaving money to our kids. There should be money for them. But we want to hedge against using up all of our assets and worrying about that. Do we have enough to leave the kids if something were to happen to us? And one of their concerns a little bit is sort of this lopsidedness of their policies. Joseph, probably maybe stereotypically, was the larger earner for most of their working years. So he has $290,000 of cash value built up in 2 life insurance policies. Catherine has one policy, it's smaller, but has about $60,000. So we have an imbalance of cash values. So we can't just say, let's put all of Joseph's into a life policy with long-term care and Catherine's into a life policy with long-term care, because it's so imbalanced. So what we looked at is 3 different policies. Sort of a neat way of going about this. We took Joseph's smaller life insurance policy and used that into a life insurance policy with a long-term care rider on just him. And the way his design was that the death benefit is going to equal his premiums paid, $4,500 of monthly long-term care benefits with a 4-year 3% compound long-term care benefit. So used his cash values towards a life insurance policy with big long-term care benefits. If he dies without needing long-term care, somebody gets $118,000. If he dies after using $18,000 of long-term care benefits, somebody gets $100,290. Catherine, we have $60,000 of cash value, $72,000 death benefit, $3,000 of monthly long-term care for a 4-year 3% compound. So we've taken 2 of these, his and hers, given them each some long-term care coverage. But then we have this one larger policy. And what we looked at for this one is using an annuity. The annuity has a neat benefit in that it can go from a life insurance policy on Joseph to an annuity owned by Joseph, but we can add Catherine on as a person eligible to receive long-term care benefits. She can't get access to the cash values or anything, but she and him are eligible to receive long-term care benefits from the annuity. So it's really neat. We're using his cash values and creating something that they can both use for long-term care. So it has $168,000 cash value, $4,300 per month for 5.5 years of shared care. So if she goes on claim, she can use up her life policy, the $3,000 a month for 4 years at 3% compound, and then start dipping into the annuity. They can both be on claim at the same time and receive. He can receive $4,500 a month. She can receive $3,000. They can both be using the annuity. So at the end of the day, if they both happen to be on claim at exactly the same time, they have a combined monthly benefit of $16,000 a month and a $647,000 long-term care pool that's growing because of the inflation on those life policies. And the annuity is going to grow a little bit too, not much, but that pool is growing bigger. So we took his policy for a life policy on him, her policy, a life policy on her, his large policy into a joint long-term care annuity, and it all just came together like that. So they were as excited as kids at Christmas that all of this worked together. Okay, that may be a stretch. Is anybody really ever that excited about insurance? Probably not. And so we needed a wrap-up slide. Okay, wrap-up slide. Taylor told me I needed one, but we covered policy reviews for life insurance, long-term care, disability, all the things that we do. I didn't cover really annuity reviews because there's so many different flavors, but happy to be a resource for you and your clients the rest of this year, all through next year and the coming years. So as I wrap up, I just want to say thank you to everybody. Thank you for tuning into the webinars. Thank you for calling us, emailing me throughout the year. I hope next year we can do it again. Depending on where you are in the country, this is really enticing right now. Come to the LLIS Insurance Academy, February 21st through 23rd at Sheridan Sand Key in Clearwater, Florida. Yes, and the hotel really does look like that. I remember seeing this the first time and thinking that's got to be airbrushed or photoshopped or something, but no, the beach really is that long. It looks just like that. It was great last year. The hotel was fantastic. They did a great job for us. So it's repeat from where we were last year. I hope everybody who wants to make it can come. If you're not familiar with us, an LLIS, we're not your competition. We don't do the financial planning. We don't manage money. What we do is we partner with fee-only advisors to be that insurance resource. Help your clients save money. Do a lot to try to help you save time. Let us help review those existing policies. We do a lot of pre-underwriting to avoid surprises. We have a lot of advisor tools and client tools on our websites. We're proud sponsors of a number of different fee-only advisory groups, and they're wonderful relationships that we get to go to the conferences every year and get to see people. You can recognize people's email signatures and voices over the phone, but it's great to get to see people in place too. We have specialists in the life insurance, disability, long-term care arenas, annuities, and the hybrids. And we keep you and your clients up to date through the application process if they do decide to move forward. Alice, our website is up and running. If you haven't logged in, I highly recommend it. We worked a lot to get things that advisors had asked us for, the ability to see clients' information sort of all in one place. So there's a lot that I wanted to have done. There's a lot that advisors have asked for. There's sort of an unlimited number of things we can do. So as you use it, try it out. Please feel free to send me feedback, good, bad, the ugly, all of those. And just thank you all very much again for everything this year. Like I said, if I could come down everybody's chimney and deliver you presents, I would, but not feasible. So thank you, everybody. I have one or two questions here I'll see if I can get to. If I don't get to your questions, then I'll follow up here with some emails later. One of the questions was, are there any MEC issues with the exchanges? No. The MECs are mostly concerned with new premium. And so you really can't make a policy a MEC if the only money coming in is a 1035 exchange of non-MEC'd money. So you could do a 1035 exchange that's not a MEC or modified endowment contract, and then put some additional money in, and that could trigger it. But so part of we're doing a solve for minimum face amounts, making sure it doesn't come into any guidelines of different things. But so anything going over that's not a MEC won't have another policy become a MEC, even if we had the same policy and wrote a check, it would be. So I hope that helps. Let me know if I wasn't clear on that. Let's see, one more. So do you typically have to reach out to the insurance company to get the basis? Yes. There's a lot of different things that go into a policy, and we can make assumptions, and a lot of times I do, on what somebody's cost basis might be. If somebody says they've paid the $200 a month since they took out the policy. I can estimate that the premium, that the cost basis is $200 times however many months, years they've had the policy in place. What really gets tricky is when policies already have policy loans, or I see maybe whole life policies where they're using dividends to pay premiums, or UL policies where nobody made you can see that there were no premiums paid in the last year. It's really hard to tell how much premium has been paid in or not. Even trickier is if there was a 1035 exchange to start this policy, that 1035 has its own cost basis. So there could be $100,000 in the policy. I paid in $30,000 in cash and a $70,000 exchange. There's no real way of knowing what the cost basis is in that $70,000 without getting the insurance company to tell you what it is. So, if we can make guesstimates and kind of be close. And I do that a lot of times to say maybe little to no taxable gain. When you get into some of these where there's $150,000 of cash value and it may be a $70,000 or $80,000 cost basis, we want to know a little bit more, what sort of taxable event there may or may not be. All right, everybody. Well, thank you. I've gone over on my time. Again, thank you everybody for tuning in, and hope to see everybody next year. Thanks.